our broad mandate, which is what we believe still to be the priority, which is creating planetary scale climate solutions. Now, we sometimes gloss over this and sometimes move past this quickly and just focus on the operational pieces of the business. But I think it's worth remembering why we're here and why we're doing this. The demand for climate solutions is coming from corporates that have recognized the need to take action on climate change on behalf of their shareholders and customers. We know there's a fatigue with the pace at which government is providing these solutions. We're coming into another COP conference now, where most of us expect very low, go into it with very low expectations. And there's a famous quote, every COP, everyone goes into low expectations, and every time they're not disappointed by those. So we're just not expecting to see government leadership on this, which is why private sector leadership at scale matters increasingly if we're going to hit the kind of climate targets that we're talking about. I say this all the time, 20% of global greenhouse gas emissions come from land degradation and deforestation. Even if you're not a big believer in climate change, stopping people cutting down tropical forests and replanting those areas increases biodiversity, increases income for smallholders who are living in the worst poverty conditions, stabilizes soils, helps manage local meteorology, provides habitat, provides a wide range of environmental services to generate income. So we're big believers in a kind of no regrets approach to climate policy, and stopping global deforestation and reversing land degradation makes sense wherever you sit on the spectrum. We also think that our company, as one of the few listed public companies to take this approach, we're a proving ground for demonstrating that we can mobilize capital, we can be an upstream developer, owner, and operator, and then sell these projects wholesale. And we're seeing no change in the scale of that demand from large final emitters and from funds and from commodity traders, as much as the activity on the public exchanges appears to be slowing. What I can tell you is we've got just as much interest from in these long-term offtake and purchase agreements. In fact, more interest now we've proven the model out than we had even 12 or 18 months ago when we started this. So as much as the market is down, as much as there's pessimism, in the end, the big corporates are mobilizing capital on a huge scale. Mercuria has a $500 million fund. All of the oil and gas majors have committed $300 to $500 million into developing pipeline in this space, and the same is true of many of the technology companies. So we see a very active market on the buying side, a very active market from the funds that are getting into this space. Quick executive summary. Our leadership team's developed over 50 million tons to date, ranging from a 6.5 million hectare conservation project I developed in British Columbia. We've restored already 10,000 hectares, including land in Sierra Leone. Our technical team, Sylvestrum, wrote the book on mangrove carbon and wetlands carbon, had been involved in developing hundreds of millions of tons of credits. Our proof of concept from our launch and listing a year ago, so just 12 months ago, we said, let's go out and develop a project to scale, get a pre-purchase agreement in place with a large off-taker, following the model that we would in the oil and gas sector. Nobody would build an LNG plant without knowing they had customers. In this case, we didn't want to build a project without knowing we had a buyer, and we have a pre-purchase agreement in place with one of the largest buyers in the market for the first 5,000 hectares. Not only did we get an offtake agreement, we got them to fund the capex for the development, remaining capex for the development of that project. So for the $2 million roughly that we put into Sierra Leone, the balance of the cost of that project is being covered by the pre-purchaser, and they have a right to step into the next 20,000 hectares of that land. They're completing a site visit in October. We meet with them on a bi-weekly basis. We have a very strong relationship with the buyer now, and we expect to see lots more activity from them over the next 2 or 3 quarters. The demand for credits continues to grow. It ranges from estimates of 5 to 15x growth in demand, depending on when you look at the Boston Consulting Group or the Task Force on Voluntary Carbon Markets. We don't really worry too much about competitors because there's so much new emerging demand. All of our colleagues and associates and apparent competitors at the high end, the high quality end of the owner-operator ecosystem actually talk to each other, compare notes, and are all struggling to meet the scale of demand that's coming down the pipeline. So we have very high levels of optimism about the projects that we're developing. We've secured to date projects that will deliver 43 million tons at a high level of de-risking. So we have high levels of confidence about those. This doesn't include our projects in Suriname, which are at the early stages of PDD. We haven't quantified those yet because we're still completing the science work. But what we do know from 100 sample sites within the mangrove area is there's large amounts of methane coming off that project. And if we restore the tidal flows, we'll eliminate that methane and generate somewhere between 400 and 800 tons per hectare of emission savings right at the front end of that project. In terms of our model, there are other players, publicly listed companies in this space. I won't name them, but what we know is that there's consulting companies that take very small equity, earned in equity positions in the business. I started one of those. They're great companies with amazing technical teams, but they don't deploy equity at risk into the project, so they don't own a big portion of the future revenue streams. There are streaming and royalty companies in the market, and the struggle they have is that the buyers want very strong hands-on control over the design and implementation of these projects. Anyone who has a good project will already be able to pre-sell it to a large final emitter or a fund. So there's much less of a niche for the royalty and streaming companies than they anticipated, because anyone who has good high-quality projects can probably find a buyer for them. The streaming and royalty companies are also often looking for fully developed projects that were producing credits already, and most of the capital at the moment is going into early de-risking of projects. We're seeing very low pricing on things like NGO for conservation projects. We're seeing very strong interest from our buyers at the $15 to $20 ton range for contracts. We're seeing prices as high as $30 a ton for mangrove projects. So, as I said before, our model is de-risk the project using our equity, be an owner-operator, develop the projects to a stage where we can secure those pre-purchase funding, and then use that money to run the business. That applies very much to our restoration projects. For the conservation projects that we've been working on, particularly in Sierra Leone, there's 25,000 hectares in Yucatan. There's about 10,000, up to 10,000 hectares in Sierra Leone of mangrove. The real benefit of those projects is we see not just this S-curve, slow incremental growth in production, but we get a big bump in production up front. And just the first 3,000 hectares in Sierra Leone in the conservation project, which we're close to completing the PDD on and monetizing later this year or early next year, 3,000 hectares at $400 tons per hectare at $20 to $30 a ton could be a $16 to $24 million sale for us sometime early next year. So our goal is to get to that point and then be able to use those revenues to continue to grow our pipeline without having to come back to the market. So strong relationships with corporates, very hands-on in terms of owner-operator relationships in the field, and then a pretty strong profile of buying interest under competitive terms. A lot of these slides I'll go through quickly to get down to just some of the summary of the progress on our projects. We've publicized and talked at length about major milestones related to this first buyer. We announced the completion of those milestones and the triggering of the disbursement of the first round of funding under that agreement. We received that first $500,000 US. We have a second trigger at the end of August where we would expect to see the second payment sometime in September for the second $500,000, and all of that funding goes into supporting planting on the ground. So I know there's been a bit of chatter. There was perhaps some ambiguity in our press release. We didn't immediately receive the funding the day after we announced the milestones. It takes these large corporates a while to move money around. But we've received the first, and we're on track for receiving the second disbursement sometime in February. There's a site visit underway, planned for early October. After that site visit's completed, we expect to see them trigger the right of first offer on the remaining 20,000 hectares and finalize the terms that we need to meet for that. So very strong Q3, Q4 transition with that site visit. Handsome and noble team with lots of experience. Many of you will have seen these slides about where the demand is coming from. It is worth reinforcing the point that 1,500 corporations have made net zero commitments in recent years, public companies where the regulators are now expecting them to demonstrate their plan for delivering on net zero. None of these companies can get to net zero without a large volume of carbon credits. And so what we're seeing now is a third of the global's economy's market capitalization had set targets to reduce or offset their carbon emissions. So just take that in for a moment. 4,000 companies and 1/3 of the world's market capitalization setting net zero targets. If you have any questions about where the demand is coming from, it's answered by these kinds of articles and reports. As we've said before, our approach is unlocking, industrializing the scale at which these projects work. It has been a small-scale artisanal business. We've brought contract structures and metrics and approaches from the resource sector to bear on these projects. When we talk to energy analysts in places and the commodity traders, our contract structures look very familiar to them by design. So it's easy for them to see how this would fit into energy procurement, into commodity procurement, because we've deliberately designed them to look very familiar to those large final buyers. Some of the precedent transactions, again, not necessarily showing up on the public exchanges, which really display the sale of the leftovers from the carbon credit markets. 70 to 80% of the volume is still coming from OTC private contracts from large final buyers. Delta Blue Carbon, which is a similar project to what we're doing in Sierra Leone, 350,000 hectares of mangrove conservation and restoration, producing 140 million tons over its lifetime. 50,000 credits sold in June 2023 at auction, sold at a weighted average price of $29 per ton. Wildlife Works, private company again, so hard for you to see as you look at public companies, but has a $200 million working line from Hartree Solutions, who were already in active discussions with to deploy capital into its project pipeline. So again, our model is to go direct to the wholesale buyers and to have them share the risk of project development with this, and there's very strong market precedents for that. We built this graphic just to explain how our approach, which combines conservation and restoration projects, works. The top line shows how the carbon volumes look like from a conservation project. So when you conserve a mango grove, you stop 400 to 1,000 tons per hectare from being emitted primarily from the sediments. When the sediments get drained for rice paddies or for firewood, that carbon is released over a short period of time up into the atmosphere. So when we protect those areas, we get a big bump up front from the avoided emissions. And then that tapering off that you see is back to a steady state where a mature mangrove might sequester 5 to 8 tons per hectare per year. The restoration of a mangrove, and we have a neighboring restoration site in Sierra Leone, will see a slower growth as we plant the mangroves up to the kind of apex, the S-curve that you see here of 10 to 15 tons per hectare. That can happen fairly quickly with mangroves over 5 to 8 years. The beauty of the approach within our business is there's real complementarity between these two revenue profiles. So as the revenues start to decline from that first bump of conservation credits, we can take that capital from the conservation sales and use that to fund and expand our restoration work and build our pipeline. So our goal is to become as far as possible self-financing by early 2024, so that our revenue profile really is built on monetizing conservation and using that to fund restoration and building ultimately these long-term recurring incomes and reserves from that investment. I know there'll be questions about this, so I'll come back to these at the end. I've shared this slide lots of times before. The punchline of this slide, despite all the text on it, is it doesn't cost us very much to develop and de-risk these projects to a scale where we can offtake them, sell them to off-takers. We're typically spending under $1 million to get to a project that, you know, in the case of the first 5,000 hectares from Sierra Leone, could generate $110 million of revenue over the 30 years of the project. that we're expanding that to 25,000 hectares, generating on the same assumptions 460 million of revenue over that first 30 years of the project. We're spending about $2 million up front to get to that stage. So our return on equity on the capital at risk up front is incredible from an investor's perspective. This is, again, also in the slide deck that's on the website, the status of our current projects. We're in the final stages, moving now to validation of Sierra Leone 1 and 2. It's the same underlying PDD document that we'll use across the project sites. We're in the final stages of the restoration and conservation projects in Sierra Leone in terms of PDD development. So we'll take those into the market in Q3 and Q4. Yucatan mangroves, it's taken a little bit longer because we've had to spend, we're the only company that's really spent the time and effort to understand how you confirm and clarify ownership rights between federal and state governments in Mexico. So we've got precedent-setting legal work there that will give us access to up to 100,000 hectares. And then in Suriname, we've got a very fast-moving project looking at mangrove restoration on the coastline. Again, these slides are also shared in the deck. We can dive into more detail on those. This gives you sort of indications of cumulative equity investment, which flattens out over the first 8 years of the project. Really, the story here is once these projects are built, the recurring revenue from these project sites is pretty incredible relative to the cumulative equity investment that we need to make. So our pipeline of 43 million tons, if we, and if carbon prices maintain a 3% annual growth from our starting prices, which is a conservative approach, there's $2 billion of revenue in that on a recurring basis over the full lifespan of the projects. And then again, many of you will have seen these slides before. I won't go through them in detail, but we've got fairly detailed breakdown of target IRRs for these projects. These roll up even on an NPV basis at an 8% discount rate to well over $110 million of cumulative NPV and of NPV cumulative revenue of close to $2 billion. So I'm going to pause here and reduce the screen size and open up to questions.
Yeah, James, there's some questions that have been typed in here. If you want to start with those.
Yeah, let me start with those. So from Doug Leach, forecast revenue 2023 from the Sierra Leone 1 project. We received the pre-purchase we receive as revenue into the company. So that will be $2.5 million of revenue by the end of 2024. There's a small issue with revenue recognition from an accounting perspective. So, but we'll have that cash. We'll have $1.5 million of that by December 2023, January 2024 from the pre-purchase. Our only obligation related to that is to repay that in tons. So the first roughly 10% of the total tons that are produced by the project go to the pre-purchaser. The balance of the revenues, they have a right of first offer to purchase those and an index-linked price tied to the Platts carbon index. So 100% of the revenues from the sale of that flow through the company and are recognized at KLX. The pre-purchase, you can do the math on it, but it's a rough, somewhere between $15 and $20 a ton is what we repay those tons at. So roughly 150,000 tons goes back out to the pre-purchaser, and then the balance of the tons are sold over the lifespan of the project. Thoughts on Paris agreements? Great question on Article 6. The state aims to establish a similar system for voluntary carbon markets, only regulated, whilst voluntary carbon markets are not. Do we see any risk if Article 6 will establish a system based on high quality credits? Firstly, Article 6 will have international standards for regulating, but it's not regulated in the same way that environmental regulations occur within markets. Ultimately, the quality control will be very similar to what exists in the voluntary markets. It's worth remembering the clean development mechanism, which was in place under the Kyoto Accord, was also the foundations for the voluntary market. So we don't see any shift in quality between Article 6 and what we see in the voluntary markets. It'll be the same verification processes and there's many of the same validators doing the work. So I don't agree that one's regulated and one isn't. Both produce credits to reasonable standards of assurance from an accounting perspective. And so I just don't see the difference in quality. I don't see a risk to our business from Article 6, partly because the UNFCCC has been talking about trading mechanisms now for 15 years. It's not advanced significantly in the year since the last meeting, and the developing countries that have been told for 15 years now they're going to see $100 billion flow through the system still haven't seen it, are very skeptical about it, and are quite willing to sell their credits at free and available prices into voluntary markets right now. So we build all our projects with what's called corresponding adjustments for nationally determined contributions. But the reality is for Article 6 to work, to be operationalized, you'd have to see 2 to 3 years work minimum by the UN to develop the trading system. And then you'd have to see domestic governments in rich countries being willing to send large amounts of money to poorer countries in return for meeting their climate commitments. And I think that's an even bigger barrier, is governments don't have the political capital to send that money to meet their climate goals. Whereas voluntary markets, we've got billions of dollars of capital sitting there waiting to deploy into voluntary market production. So the biggest business risk is people are confused about it. It creates confusion that slows down our work, but I don't see any direct competition from Article 6 for at least 2 or 3 years. And Eric, I think you picked up on this. It'll take a long time to operationalize, and there is that real skepticism about the funding. Ignis as well, great question. We've seen some support for direct carbon capture to the Biden administration. Do you see any potential subsidies in the voluntary carbon markets? Direct carbon capture and storage, if you look at the cost base for that, we can produce credits from nature-based solutions, depending on the project type, anywhere between $6 and $14 per ton. The cost for producing credits from direct air capture is still well above $100 per ton. So it's a bit like the early stages of the clean tech sector. It is a good technical solution long-term, but it needs subsidies on R&D to get to scale. I think the subsidies in the voluntary carbon markets are going to come from development finance institutions. So DFIs that deploy capital, USAID, CDC in the UK, are all building programs to support infrastructure development for the carbon markets. We have a number of applications out to IFC, USAID, CDC. We want to massively enhance nursery capacity in places like Sierra Leone, and we're applying for funds to help build that kind of infrastructure. So, the appeal of doing direct carbon capture subsidies in places like the US is it's domestic investment and domestic R&D. So the money will be stayed within the sort of made in USA boundaries. I don't see national governments providing significant support for VCM or subsidies, because that's money that's leaving the country under recessionary conditions. So I think there's money out there. We're chasing a lot of it with the DFIs, but direct carbon capture needs massive subsidies because it's currently much, much too expensive to be a viable solution. PP, level of interest and planned closing date. We went out with a PP, and I'm happy to take more questions on this, because we've been approached by a number of groups that wanted to see money flow in to support the growth and development of the company, rather than satisfying the short-term interests of speculators around our share capital. And we had a couple of groups that have a long-term strategic interest in the company. So we went into it knowing that we had very strong interest, and I have no concerns about meeting the minimum that we've put out. We have, I expect, just with timing and because it's August, we'll keep it open for at least another 2 weeks, and then we expect to see funds flow and everything close by the probably second week in September. is when I anticipate making some announcements around that. But very strong interest to date. It's frustrating given some of the target prices we've seen from reports of places like Hanneman Partners show us with a target price of high 60, low 70 cents a share. Every CEO I talk to in the public markets now is suffering from a very challenging junior market. This PP will give us the ability to expand our projects in West Africa. We're working on a technology platform with smallholders to provide chain of custody all the way from where the trees are planted to the large final buyers. So you can almost sort of click on a link and see where the tree was planted. We want to be able to accelerate those and not just put everything on hold while the market returns. So private placement, obviously, you always want to do it at a higher price. We're at the mercy a little bit of speculators and shorters, which frustrates everybody. But we think it was in the interest of the company to do this now and to move quickly, because the pipeline we've announced for the fall, we're going to build very strongly and continue to be able to do these pre-purchases that bring revenues to the company on that basis. Tim expected to monetize conservation credits for 3,000 hectares in Q1 2024. Are there costs associated with that, or would we end up with more cash on the balance sheet than the current market cap? Tim, that's a great question. If we monetize it within that range, then the answer is yes, we would end up with more cash on the balance sheet. There's a revenue sharing component to that, the implementation of that project. So we share with between 30 and 40% with communities and the government. But we share that once the tons are delivered. So our cost base for those projects is really around undertaking the mapping, putting the leasehold agreements in place, and so we'll carry a lot of that working capital forwards well into through 2024. So the cost base for these conservation projects upfront is very low compared to restoration projects. Restoration, we're spending roughly $1,200 per hectare to do the planting. Our cost base for these conservation projects is much lower and much faster to get to revenue. ROFO of 20,000 hectares. We will close out the negotiation on the ROFO terms in October. There is an expectation we may have to put some more funds in to match the buyer, but it isn't a traditional equity split. So because we've already de-risked the project, we're generating revenues from it and planting from it, and we won't. The first 5,000 hectares of planting will take us well into next year to complete the planting. We think we can ramp up to 3,000 to 4,000 hectares next year. So if there is an equity requirement, that won't kick in until well after we've monetized the conservation project. So we're feeling pretty confident about that. But Steve, that's a great question. Thank you. Nick, are we open to exploring new nature-based credit ideas and research and development once cash flow is adequate to sustain tree and mangrove projects? We're already actively looking at regenerative agriculture in developing markets. We are looking at seaweed and kelp projects in the background through partnerships with some research institutions. Those are probably the biggest categories of new project type that we're looking at. So that's a sort of the new directions. Regenerative agriculture, I think, has a lot of promise. And seaweed and kelp beds, I think, will take another 2 to 3 years, but we're an early mover on that and very well positioned with some of our technology platforms for managing it. We're certainly open to looking at new jurisdictions, but our golden rule within jurisdictions is we're not a carbon company that arrives on a plane in a new country and tries to set up a new business there. We think that takes 2 to 3 years to get just understanding basic business operations in any new country. So we only work in places where we have very strong operational experience. That means that if we move into a new jurisdiction, it would only be if we acquired or partnered or JV'd with a very well-established in-country operator. The Suriname slide, it shows cumulative carbon generation of $200 million. That's not a typing error. That's what we anticipate the upper end of the revenues could be from the 30,000 hectares that we've already got under development. And the simple math on that is 500 to 800 tons per hectare of carbon from the avoided methane. We have an agreement in place with the Surinamese government to access that land. We're mapping it now. We're developing the PDD. So the scale of Suriname is really a national scale project, and there's huge areas of degraded mangrove, that we think we can restore over a 2 to 3 year period. So that's not a typing error. Timeline for an auction on Sierra Leone 2. I think once we've completed the ROFO on the first 25,000 hectares with the Fortune 100 company, we'll open that up to a secondary auction, probably in the latter part of 2024. Our rate limiting step really on growth and rate of planting in Sierra Leone is how quickly we can secure the seeds from the existing native forest. That's the rate limiting step. So we have to invest in some capacity building. We think we can get to 4,000 to 5,000 hectares of planting per year in Sierra Leone. We're raising funds to support that. It may be that if the terms for the first 25,000 hectares are strong enough, we just roll that over to the full 57,000 hectares with the current buyer. But if not, then we'll shift to an auction process for that one in, I would expect, November of this year. Ignis, which index? I'll just type it in here. It's the Platts Carbon Index. That's right. Thanks, Eric. Yeah, so the first set price, that's not quite correct, Ignis. So the tons that we repay with a pre-purchase payment, the price of that is fixed, and I'm not supposed to tell the exact number, but you can work out that it's fixed at a price well above $10 a ton. So we're guaranteed that income. If the carbon price is dropped, for instance, we still repay at that pre-agreed price. The balance of the tons, the 90% or so of the tons that we sell, we would sell to them at that index price. And we chose Platts Carbon because it's the only one that really reflects pricing of restoration projects. Effectively, we have a floor of around $17 a ton within the contract and on the basis of the Platts index. So the variability is really how much we can sell the balance of the tons for. The pre-purchase amount is repaid on the basis of that pre-agreed price. Okay, that's a rampage through the questions. Questions on the Fortune 100 company PR machine to announce the name. We are working closely with them. They're doing, as I said, the in-country due diligence and review on site in October. I think before the end of this year, we'll have an announcement on it. I would guess at the pace they've moved out on bank transfers and legal documents, I would expect it sort of November, December that we can look for an announcement on that. Great question around TSXV long term, or consider some other exchanges. I'm a fan of cross listing on exchanges, and there's lots of activity in the UK and in Europe around carbon markets. When we don't have any firm plans, I'm not saying we're definitely doing this by any means, but we're interested in what would be offered by cross listing on somewhere like AIM. We've also seen some of the European, the Nordic exchanges be very active on carbon markets. We're active in roadshows in Scandinavian countries in the fall. So a cross listing, I think, would make some sense. I think it's more likely we would go to Europe than the US, just because the investor base in Europe is really looking for opportunities around carbon much more than any other market. So would definitely consider going there. Okay, lots of
Great,
lots of
lots of questions.
familiar names. Happy to take more questions.
Anything else, guys? Oh, there's one new one.
Yeah, so Doug, can you add color on how the additional 90% of credits will create revenue in 2024? Doug, we don't expect the 90% of credits to create from Sierra Leone 1. We don't expect them to create additional revenue in 2024. We have a planting schedule. We'll see those projects grow, trees grow over time. I think we'd start seeing those revenues in 3 to 4 years from Sierra Leone 1, where we might see, where we expect to see additional revenues in Sierra Leone would be as we expand the pre-purchase agreement to 25,000 hectares, you'd effectively see 5 times the amount of pre-purchase received as the security for that, for the growth of that project. So we would expect in 24 to see more pre-purchase capital deployed and received as revenue into the company to fund the growth of the Sierra Leone project. I hope that makes sense.
James, if you were talking to a new investor in the carbon credit space, what are the 3 most important things they need to know that are factual and science-based? Because there's a lot of back and forth.
I mean, so I think that's a great question, Julie. So probably the most important things is the demand for carbon credits is coming from large final emitters. Those are companies that are regulated increasingly by SEC and in the EU to show that when they tell investors they're going carbon neutral or net zero, that they have a plan to execute on that. So if you've made a statement as a company about meeting net zero, that now has a kind of quasi-regulated obligation that you have to deliver on. So that's Mark Carney's group predicted, $30 billion of demand by 2030 if the market can satisfy it. None of those assumptions have changed. And the remarkable thing is actually in the context of inflationary pressures, of the war in Ukraine, some of the companies that are out there as the biggest buyers now have been the beneficiaries of a war dividend, effectively. Oil prices being higher, oil and gas companies having more money on their books than they've ever had for years from a profitability perspective, and huge pressure from their shareholders to address these issues of net zero. So the one thing I say to people is these are very strange market conditions for public companies. Our customers, our buyers, have never had stronger interest in buying credits of the type that we're developing. So that's the first thing is, don't believe the hype, don't believe the skeptics. The buying is, the demand is very, very strong. The second is this question that was asked earlier around Article 6. Frankly, it's a distraction. Article 6, I have very low confidence that much is going to happen around it. We get asked questions a lot about how we prepare for NDCs and Article 6 and corresponding adjustments, and we build that into all of our projects. But I don't see money flowing or competition coming from Article 6 anytime soon. I'd love to believe otherwise, and I think they'll, in some ways, as a developer, if Article 6 did implement, we're still a project owner and operator. We just have another set of customers. It's not as though the governments are going to be able to implement these projects on their own. So even if Article 6 did kick in, we'd be helping sell to the German government or help sell to the UK government to meet their obligations. My skepticism is just that I don't see the UK government cutting checks for hundreds of millions of dollars to invest in tree planting in Sierra Leone when they've got massive domestic demand from their budget. So that's the second thing is I don't worry an awful lot about that. The third is that there's been a lot of noise and rhetoric and misunderstanding around quality assurance in the carbon markets. There's been a small number of bad projects that get amplified as though the whole system is falling apart. It's kind of like saying, if you applied that to the finance sector or the banking sector, the failure of Silicon Valley Bank, you would assume then that every other bank and every other investment bank is also going to fall apart. Everyone recognized that Silicon Valley Bank was a different kind of bank with a different kind of exposure and risk. The same thing applies in the carbon markets. Of course, there's been 1 or 2 projects where there's been retroactive adjustment of the amount of credits that they produced. The interesting thing is Vera was able to manage and accommodate that and adjusted future issuances to reflect the fact that these carbon baselines are being overstated. So I find in carbon markets, one failure feeds the skeptics and everyone assumes that every other project has these problems. In practice, it's no different from Silicon Valley Bank, where one bank got overexposed, made some mistakes. That doesn't mean the entire financial system comes cascading down. So that's my third point is there's very strong quality control. Vera is still the default registry for protocols. They need to grow to scale and they're working very hard on that. But we're providing projects at reasonable standards of accounting assurance. I mean, that's what I always come back to is the quality is there. Of course, there's lessons. Of course, there's improvements over time. But there's improvements in GAAP principles over time. There's improvements in ESG accounting over time and reporting. Doesn't mean that the system is fundamentally broken just because small things are changing along the way. So I think we need to have a bit more confidence in the exchanges and give them time to grow as well.
There's a question here around the next jurisdiction that'll be finalized, or I guess like if you had to say Suriname, Sierra Leone, next project, next sale.
Well, so Suriname, we already have a binding agreement with the national government signed by the President and the Minister of Environment. And we're very active there doing the field work. And we have the biggest issue in Suriname is just going to be clarifying underlying land rights because there's a mix of government land and private land and lease land. So we need to spend some time cleaning that up, but the project potential is very high there. I would anticipate the next jurisdiction will be in West Africa and will be announced in, I would guess, in late September or early October. As we said in the roadmap and release, we're already actively working in that country and have draft agreements in place. So I'd like to be able to announce that in late September, early October. And then we think West Africa is a very strong region for us. We expect to see some growth in the scope of the program in Yucatan, just based on the strength of the relationship with government. And we may expand into one of the other states in the Yucatan Peninsula, so Quintana Roo and Campeche, and start looking at projects there. Yeah, great question, Steve. Thank you. JG, does management plan to participate in this placement? Yes, absolutely. We will finalize the quantum. It'll be a significant contribution from management in this. And I've been active buying in the market, but again, as I said earlier, I'd rather see my money go back into the company to support its growth than satisfy the short-term speculation of shorters. So we will be, all the senior management will participate in the placement, and we'll publish that as well once the total number as part of the finalization.